Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Amgen Inc., ticker symbol AMGN. We're looking at Amgen today because the company recently announced that they will acquire Horizon Therapeutics, a biopharmaceutical company that focuses on treatments for rare autoimmune diseases, in a deal that's valued at more than $26 billion. Each Horizon shareholder will receive $116.50 per share in an all-cash deal. Horizon's bestseller, Tepezza, is only approved in the United States and treats eye bulging and double vision from thyroid eye disease. So Amgen is spending more than $26 billion to dive deeper into rare disease treatments. Right now, Amgen is trading for $263.03 per share. We're recording this analysis while the market is open, so their share price is likely to bounce around just a little bit during our analysis. Amgen is up more than 19% over the last year, which is in sharp contrast to the overall market. As we dig into Amgen's fundamentals today, we're going to be trying to figure out what are we missing? What could the market possibly have discovered about this business this year that led to this sort of outperformance, especially relative to the S&P 500. So over the last 5 years, Amgen is compounding at a rate of 8.5% annually. Over 10 years, they're compounding at a rate of 12% annually. And going back prior to the global financial crisis, Amgen is compounding at a rate of about 8.5% annually. Keep in mind that the company does pay out dividends. Right now, they have an above average 2.9% dividend yield, and their average dividend yield would be in addition to this compounded annual return. Amgen right now is trading snugly between their 52-week high and their 52-week low. They're a little closer to their 52-week high. Just over 2% of their shares outstanding are currently sold short. And Amgen is a very large business. They have a $142 billion market cap. So for additional background about the company, Amgen is a leader in biotechnology-based human therapeutics with historical expertise in renal disease and cancer supportive care products. Flagship drugs include red blood cell boosters Epigen and Aranesp, immune system boosters Neuropogen and Neuralasta, and Enbrel and Otezla for inflammatory diseases. Amgen introduced its first cancer therapeutic, Bectabiz, in 2006 and markets bone-strengthening drugs Proliva, which was approved in 2010, and Evenity, which was approved in 2019. The acquisition of Onyx bolstered the firm's therapeutic oncology portfolio, and recent launches include Repatha, Aimovig, Lumakras, and Tezspire. Amgen's biosimilar portfolio includes biosimilars to Avastin, biosimilars to Herceptin, and biosimilars to Humira. The company distributes its products through pharmaceutical wholesale distributors as well as direct-to-consumer channels. So Amgen Inc. was incorporated in 1980 and is headquartered in Thousand Oaks, California. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Amgen based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that the average publicly listed business earns about a 7% return on capital. And the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And these business returns are going to be captured here by return on capital. So by asking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Amgen has earned pretty solid returns on capital over these last 5 fiscal years. Over their last 12 months, they've earned returns on capital of 24%, and averaged out over this period, Amgen's earning about a 21.5% average return on capital in a given year. So that's about 3 times better than that of a typical business, and that's solidly above that 14% benchmark we're looking for. So this is a check to start things off for metric number 1. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. And this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of them is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So over this time, Amgen has grown their revenues by about 14%, so modest revenue growth. Their earnings look like they're up more than triple, although they had a more than $7 billion income tax expense in 2017, which was far and away above what their income tax expense were in these other years. So that was an atypical year for the business. And then their free cash flows over this period are actually down by about 14%. This is slightly concerning because free cash flow is really the lifeblood of any business, and a business can use its free cash flows to reinvest back into the business, make acquisitions, buy back shares, pay down debt, or make acquisitions. Ultimately, a business's business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So it is concerning to see that their free cash flows are down here, and so this is an X on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Amgen on a per share basis. So we're looking for earnings per share growth over the last 5 years. Again, if we were excluding that income tax expense that they had in 2017, it looks like their earnings are slightly down over this period. However, earnings are just the numerator in this earnings per share equation, so we also want to take a look at what Amgen has done in terms of their shares outstanding. So likely a good sign for existing shareholders in the business. Amgen has repurchased about 25% of their shares outstanding over this period. So this is important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And so when a business buys back stock by decreasing the number of shares that they have outstanding, they're increasing your ownership percentage in the business, which is ultimately going to increase your percentage of the business's profits that you're entitled to without you having to spend a dime. So it's almost as if the company is making a partial acquisition of itself. And so just like with any other acquisition, we want the company to be buying back shares where they're getting more value for existing shareholders than the price that they're paying. You would likely want to dig in and learn more about the business to understand if this is truly going to be the case or not. But these are strong buybacks that outpace how their earnings have fallen over this period. And this is a check here on metric number 3 as their earnings per share have grown over this time. Then next up, metric number 4 is going to be very similar. So here we're looking for free cash flow per share growth over the last 5 years. Very similar story to their earnings. Their free cash flows are slightly down by about 14% over this period, but with their 25% buybacks, their free cash flows per share are up at the same time. So this is a check here on metric number 4, and through our first 4 metrics, we have 3 checks and only 1 X so far for Amgen. You might think that nailing high average returns on capital and having good per share growth is the key to compounding intrinsic value, but there's still one piece missing, and we haven't touched on one of the key things that I believe sets truly wonderful businesses apart. So that brings us to metric number 5, where we're evaluating how the business is utilizing leverage. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that Amgen has produced over the last 5 years. Amgen ended 2021 with about $26 billion worth of net debt. With their pending acquisition of Horizon, they're adding $26 billion worth of net debt to this position. So that would be about a $52 billion total net debt position. And over the last 5 years, Amgen has only produced about $48 billion worth of free cash flow. So while that is able to support their current debt loads with quite a bit of room, based off their pending acquisition of Horizon, it looks like Amgen's free cash flows would not be able to support their debt load. However, it's worth being aware that Horizon has produced more than $1 billion in free cash flow over their last 12 months. So this would likely mean that Amgen and Horizon's businesses combined together would be able to support this debt load. So this is a check here on metric number 5. One thing to be aware of, though, is that over the last 5 years, Amgen has heavily relied on acquisitions to fuel its future growth and to grow its biotech pipeline. So the company went from having $6 billion in cash in 2017 to now they have more than $50 billion in net debt today. So they have added on quite a bit of debt in recent years to fuel these acquisitions. Either way, though, again, this is a check on metric number 5. And so far, through our first 5 metrics, we have 4 checks and 1 X for Amgen. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium to the yield of the 10-year treasury and potentially give us another reason to be interested in Amgen. We're using their total enterprise value because it's going to take into account both their market cap and their net debt position, and it's going to give us a more economically realistic picture of Amgen's business that's more similar to if Amgen were a private company. So right now, Amgen has a $169 billion total enterprise value, and we learned that over the last 5 years, they produced about $48 billion worth of free cash flow, meaning that in an average year, Amgen is producing about $9.6 billion worth of free cash flow. When we divide their $9.6 billion of their average free cash flow by their $169 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of about 5.7%. So that is above that 5% benchmark, and on a historical basis, this is a check here for metric number 6. Also worth being aware of is that over their last 12 months, their free cash flows are down slightly from where they've been at historically. So Amgen has produced about $9 billion worth of free cash flow over this time. So to get a current free cash flow to enterprise value yield for the business, when we divide their $9 billion of their last 12 months of free cash flow by their $169 billion total enterprise value, that gives us about a 5.3% current free cash flow to enterprise value yield. So on both a historical and an average basis, it looks like Amgen is potentially offering a slight risk premium to the yield of the 10-year treasury. And this again is a check on metric number 6. Just because this is a check here doesn't mean that you're going to run out and buy the business. This is not a buy or sell recommendation of any security. This is just one of our 6 metrics, and this analysis is meant to be taken in holistically. So even though these metrics are simple, when combined together, they can be very powerful. Then as a bonus, here we're taking a look at Amgen's dividend profile. So again, Amgen currently pays out an above average 2.9% dividend yield. This is a dividend yield that's higher than that of an S&P 500 ETF right now. However, people make mistakes all the time by blindly chasing dividend yields. So it's important to stop and look at the underlying fundamentals of a business and to determine whether that business's dividends are well supported by either their earnings or their free cash flows, depending on the type of business. So for Amgen, we want their dividends to be supported by their free cash flows, and this was the case in all 5 of these years. Amgen has very easily been able to support their dividend payouts with their free cash flows. However, keep in mind that they have added on quite a bit of debt over this time as well. So more and more of the business's cash is going to be devoted to either servicing or paying down that business's debt. One thing to notice here is that Amgen has increased their dividend payouts per share. This is likely as a mix of both an increased dividend over this period and because of their company's buybacks. But they've done this at a rate that's much faster than how they've increased their free cash flows per share. So their recent dividend growth is likely not sustainable going forward into the future for the business, but it does look like they should be able to incrementally grow their dividend, albeit likely at a pace that's slower than their free cash flow per share growth. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Amgen, which takes us on to using a discounted cash flow model to come to a potential fair value for Amgen. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with inputs of their average free cash flows over their last 5 years. And we're using historical growth assumptions for how the business has grown their free cash flows dating back all the way till 1990 to project future growth for the business. So these are historical growth assumptions that you need to do your own homework on to determine whether or not these are going to be potentially accurate and applicable going forward to give us a baseline projected estimate for Amgen over the next 20 years. So if we assume a growth stage over the next 10 years where they grow their average free cash flows at a rate of 11.5% annually, then we assume a terminal stage for the 10 years out after that where this growth rate is cut in half and they're growing their average free cash flows at a rate of about 6% annually. If we add in their tangible book value today and we're seeking a potential 10% rate of return going forward for Amgen, then it looks like a fair value for the business is right around $267 per share. So please keep in mind a couple of caveats here. One is that this discount rate would be including their dividend payouts. So 2.9% of this return would be coming directly from their dividends, and we would not be doubly counting their dividends here. There are a number of reasons why this might not be potentially accurate for the business, so that's why it's really worth diving in and learning about the business in more depth. So please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our recap for Amgen, but we have to address something first. What are some of the qualitative aspects of this business, especially the qualitative factors around the key points for a potential long or a potential short thesis of the company? Starting with some of the key points around a potential long thesis for the business. Number one, Amgen's improved manufacturing efficiency not only will benefit gross margins, but could also give the firm a cost advantage in the biosimilar market. Number two, the acquisition of Decode gave Amgen the ability to identify potential new drug targets, validated by human genetics, and the firm continues to build on this database. And number three, Amgen's pipeline has been stale since the launch of Prolia, but cholesterol drug Repatha and migraine drug Aimovig revived potential enthusiasm for the firm's research engine, and Lumakras and Tezspire also look differentiated. Then for some of the key points around a potential short thesis for the company. Number one, Amgen lacks the focus of some of its biotech peers, with drugs targeting large markets like osteoporosis and cardiology and specialty markets like immunology and oncology. Number two, Amgen's position in blood cancer is uncertain, as Kyprolis sales haven't lived up to expectations from the $10 billion Onyx acquisition, and Johnson & Johnson/Genmab's Darzalex and BCMA targeted therapies are likely to be strong competition. And number three, biosimilars have been on the market in Europe since 2007, but biosimilars have had a larger impact on Amgen since 2019, as U.S. exposure intensifies. So hopefully that offers a balanced perspective around some of the key qualitative aspects of the business for a potential short or a potential long thesis of the company. Now it's time for our wrap up. So in summary, Amgen checks the box on 5 out of 6 of our metrics. They're earning average returns on capital that are significantly above average in the low 20% range. Their revenues are up over this period. However, their earnings and their free cash flows are down. So both their gross margin and their operating margin are down over this period as well. However, Amgen has repurchased 25% of their shares outstanding. So on a per share basis, even with their decline in their earnings and free cash flows, they've actually grown over this period. Then, even though the company is paying $26 billion in cash for their acquisition of Horizon Therapeutics, it looks like those combined businesses are going to be able to support their debt loads going forward. And prior to that acquisition, Amgen was in a very healthy spot in terms of their net debt relative to their free cash flows. Then comparing both their average and their current free cash flows to their enterprise value, it looks like that gives us a potential risk premium if we're taking the yield of that and comparing that to the 10-year treasury yield. So it's likely worth your time and energy to dig in and learn more about Amgen. Looking at their dividend profile, Amgen has steadily increased their dividend in all 5 of the previous years, and they've had more than enough free cash flow per share to be able to pay out this dividend, although they have grown their dividend at a rate that's much faster than they've grown their free cash flows per share at the same time. So future dividend growth for the business is likely to be slower than it has been in the past, unless they're able to grow their free cash flows at a much more rapid rate going forward. And finally, performing a discounted cash flow analysis of Amgen. If you've done the work and you believe those historical growth assumptions, then it looks like from today's valuations, you could reasonably expect about a 10% rate of return going forward from the business, with about a $267 fair value for the company. So again, there are a number of reasons why that might not be applicable going forward for Amgen, and their dividend payout of 2.9% would be included in that 10% return. So the business would be performing slightly worse than it has over the last 20 years or so. It's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Amgen. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. As a value investor, you're ultimately trying to conduct this deeper research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company and understand its underlying essence. So through this deeper research, you'll likely learn more about the qualitative and the quantitative aspects of Amgen's business, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Amgen Inc., ticker symbol AMGN. Again, we looked at this business because of Amgen's recent announcement that they're going to acquire Horizon Therapeutics. So if you learned something and or you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Amgen with me, and have a great day.